Welcome to This Week in Money. I'm Jim Goddard. Today, Martin Straith from the TrendLetter.com runs down the major markets that saw a major roller coaster during the week and still managed to land in positive territory. Martin digs into gold, crude, the U.S. and Canadian dollars. He also looks at President Trump's tariff war with most of the world and the risks it carries. InsideTrackTrading.com President Eric Hadik looks at the cycles affecting the stock markets, currencies, Bitcoin, oil, and even wars. His call on the stock markets was surprisingly accurate. Author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, tells us while the Calgary and Edmonton real estate markets are holding up, the rest of Canada is in a sales drought. He also says, in a disturbing rare move, homeowners are now seeking credit counseling as the equity in their homes disappears. We'll talk to Martin Straith right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
My pleasure, Jim. Good to be here.
Martin, how would you describe what happened on the stock markets this week?
Oh, I don't think anything really happened, Jim. It was a pretty quiet week, wasn't it? My God, eh?
The most turbulent week in history?
Yeah. Well, I mean, for sure. I mean, look at all the whipsaw action. I mean, the S&P 500 is, what do we have here? It's up about 90 right now, right near the close. So, and you know, it's interesting. With all that whipsaw action, it looks like this will close as the best week since 2023. So, at the net result there of all those ups and downs, amazing. You know, it's interesting though that the markets hate uncertainty, and man, have we had so much uncertainty since April 2nd, Liberation Day, and since that day, we've seen the VIX volatility index over 30 every day, and the last time we saw that kind of volatility was back in 2008 at the financial crisis. But I mean, you know, that kind of, you know, that's, April 2nd, that's only 9 days ago, and it doesn't seem like 2 months ago. So anyways, so looking at the S&P 500, you know, we've got U.S. and China, you know, the two largest economies are in a seemingly full-on trade war right now. And again, we had such wild swings this week. So the S&P now is traded this week. It traded in a 14% range from the low of 4,800 to the high of 5,500. So what we need to do now is we need to see, you know, which way it's going to be. Does it want to be bullish, or does it need to break through 5,500? That would have to be, and if it could do that, then it would need to get to 5,700 to really be, you know, kind of consider that the bottom was in. Now, support, so that 4,800, that would be the key support level for this, you know, next week here. If it breaks 4,800, then you'd be looking at 4,600. But the interesting thing to me is, I mean, as we saw, if anybody watching the market this week, we saw both the buy the dip and sell the rip crowds in full action this week. Investors trying to capitalize on these wild swings. And as I say, you know, so the S&P's up here today about 90, so it's sitting at about 53.60. So, you know, about 150 or so below that 5,500 resistance level. So again, so today, you know, we got the dip buyers are in control. So the market's trying to find a bottom here, at least in the short term. We've got no clear direction on tariffs. You know, this 90-day delay or pause, I mean, to me, that just adds some more uncertainty. Now, like, what do we wait? We wait 3 months, and then then what? And then, of course, we've got this trade war between China and the U.S., So to me and to your listeners, I just think we're still going to see a fair bit of volatility here going forward.
What happened with gold?
Well, again, another wild area. I mean, gold is on a total rip right now. Now, looking right here, it's up about $70 again today. So another new all-time high at $32.50. Now, we did have a sell-off last week. Remember we had that big panic liquidation, and we saw gold and gold shares sell off. I mean, gold went down to about $29.70, I think it was. And, that was really kind of a case of the baby getting thrown out with the bathwater. But, then we saw investors, they kind of look around and they're going, well, what are the real safe haven plays here with all this volatility, all this, trade noise and so on? Do you want to buy U.S. Treasuries or do you want to buy the yen? And really, other than gold, there are not very many safe haven alternatives right now. Bitcoin, which a lot of people consider to be the, digital gold, it's been moving way more with the NASDAQ than it has been with gold. So it has not been a safe haven play. So with gold, I don't see much of a bear case at all for gold right now. I just look at the commitment and trader data. Now this is, comes out on Tuesday, but it's really dated back to Friday. It showed long positions year over year were at the lows for the year last Friday. So that's suggesting this is not an overcrowded trade. Now, gold is overvalued, certainly compared to a lot of other markets. Historically, the gold-oil ratio is usually about 20 to 1, meaning that, it would take 20 barrels of oil to buy 1 ounce of gold. Well, today with gold at $32.50 and oil at $60, I mean, that ratio is now 50 to 1. So that's over double the norm. The gold-silver ratio, normally around 50 to 60 to 1. Today, an ounce of gold will buy 103 ounces of silver. So, these are historically high ratios, but of course they're high for a reason. So, before the trade war, we already had some serious trust problems. I know we've talked about it on your show lots of times, where the West seized all the Russian assets, kicked Russia off the SWIFT system, and then all those countries that are not aligned with the West, so Russia, China, and Iran, they didn't trust the West anymore because the financial system could be used as a leveraged geopolitical weapon. So they started buying gold, and they've been buying gold. I know last month we talked about how much gold they were buying, but they're continuing to buy it. And as we get these trade conflicts now, that's intensifying globally, and that gives these central banks even more reason to buy gold. And now, of course, we've got retail investors looking for a safe haven place to put their capital. Well, gold's benefiting from that fear as well. So again, we've got gold up about $70 a day, a new all-time high. So it's at $32.50 today. 3,300 will be our next resistance level. The first support level on our models is $30.50, and you've got strong support at $29.60, and that's that low we saw last week. So again, gold for now is on a rip higher. It could level off for a bit, but again, I do not see a bear case for gold anytime soon.
Crude, what's the story there?
Well, oil's, it's up about, I think it was $1.50 last I saw, so we're up to about 61.60. So it's kind of hanging in there a little bit. But we've seen a lot of selling from hedge funds. We've had some margin calls for sure. I think we could have some more of those. Could drive the price quite a bit lower. Obviously we've got recession fears globally with all the tariff threats. We've got the two largest economies, the U.S. and China, in an escalating trade war. Every day we're hearing, another weapon put into the game here. So ultimately, trade discussions should start soon. Hopefully, we get some calm, but I can't see that happening anytime short term. All of these tensions, they just add to the recession fear. Recession fears mean lower demand for oil. So it's a pretty negative fundamental story. It's a pretty negative technical story. So looking at the charts, I'm looking at a chart of oil right now, and it had what's called a liquidity void this week. And really what that is it had a gap down from about $69 down to about $62.50. So that was a straight drop. And since then, oil's been in this range where that high is $62.50 down to the low of $57. If 57 doesn't hold, I could see oil drop down to $54. I doubt we're going to get much higher than $62.50 in the next little while, although we're within $1 of it right now. So we'll see if oil can get a bit of a rally here. But my take on oil prices remains that it's going to be fairly low for the time being, and it's going to take some real calm in the markets here before we start to see that the global markets, the global economy is just going to start feeling good again.
What's going on with the U.S. and Canadian dollars?
Well, currencies, I always say this, it's all connected. So it really is driven by what's happening with the U.S. dollar. If the U.S. dollar is rising, other currencies are declining. U.S. dollar is declining, other currencies are rising. Well, this trade war, we are seeing the U.S. dollar get absolutely hammered here. It is down 10% so far this year. So we're seeing, the Canadian, the euro, the yen, the pound, they're all rising. So something that we're watching closely is that, because of this trade war, you've got many foreign pension funds and institutions that they're starting to sell U.S. assets, and they're looking to support more of the domestic ones. So that means that they're going to sell these assets, and then they're going to convert those U.S. dollars from those sales, and they convert them back into their local currency. And I think that's really driving a lot what's going on here. And that obviously pushes the U.S. dollar lower. So the U.S. dollar rate here is testing a key support level. It was tested in August, tested it again in September. It held both times there. So we're going to see. It's technically oversold here. So we'll see if this support level holds or if we get a new low. Now, for the Canadian, it wasn't that long ago that we saw the Canadian dollar drop down to 68, I think it was 68.30 in February, and that was a 23-year low. But since then, with all this tariff noise and the U.S. dollar tanking, the Canadian dollar has been just ripping higher here. It's up another almost 50 cents today, or half a cent today. So it's just over 72 cents today. Now, that's a rise of almost 7% in the last 6 weeks, which is quite remarkable. And as I noted, you got pension fund like the Canadian Pension Plan. Now, they are being pressured to not be supporting U.S. stocks or bonds right now and to be more supportive of Canadian assets. And like I said, I think you've seen that all over the globe. All these countries that Trump has been picking a fight with, they're going, well, why are we supporting your assets and your bonds? So that's something to really be keeping an eye on. So I think that you're going to see the Canadian dollar top out here soon, certainly at least the short term. Next support level will be 70 cents, so it's 72 today. And as I say, though, it's all connected, heavily driven by what happens to the U.S. dollar.
What's your take on the tariff turmoil?
Yeah. Basically, to put in a nutshell, what we've got here right now is we've got the president of the most powerful country in the world who is pissed off at pretty much every country in the world. And so that's where we are. So we now have this tariff, turmoil, as you say. So, let's define what's a tariff. Well, a tariff, really, a tariff is a tax imposed by a government on the goods and services imported from other countries. So it increases the price of these imports, so it makes them less competitive compared to the domestic product. That's the concept. But who pays the tariff? You keep sort of hearing, it makes it sound like the country's paying the tariff. Well, no. The importer who wants those products is paying the tariff. And then that person is going to sell to, wholesales or different, retailers or whoever is using that particular product. And what all along that chain is what's going to happen is they're going to pass on those extra costs, and then who ends up paying for it? It'll be the consumer. So one of the most confusing things, I think, for people is what's happening is how the Trump team has calculated these tariffs. They are not based on the tariffs from the actual tariffs other countries have been imposing on U.S. goods. What they've done is they're taking the trade deficit that the U.S. has on a specific country, and they're using the trade deficit as a basis for the tariff calculation. So here's what they do. They take the trade deficit with a country. They then divide that by the total imports from that country, and then they divide that result in half. So here's an example. So for Vietnam, the U.S. imports $136.6 billion worth of goods from Vietnam. And the U.S. has a trade deficit of $123.5 billion. So what they've done is they've taken that $123.5 billion, divided it, so that's the trade deficit, divided it by 136.6, which is the amount of goods that they've imported from Vietnam, and then they split that in half. And so for Vietnam, that total ends up at 46%. It has nothing to do with tariffs that Vietnam is imposing on the U.S. It's totally based on trade deficit. So the U.S. has a trade deficit with almost every country, and the reason is pretty simple, because it's the largest economy in the world. So the U.S., the U.S. nominal GDP is projected to be just over $30 trillion by the end of this year. China is the second largest at just $18 trillion. So the U.S. economy is 40% larger than the Chinese economy, the second largest economy. So that's how much bigger the U.S. is versus anybody else in the world. You compare it to Canada, the U.S. economy is 175% larger than Canada. So the U.S. also has the largest consumer market in the world, and it's driven by exceptionally high disposable income per capita. I mean, I think only Luxembourg has a higher disposable income. So it's virtually impossible for Canada or any other country to have a trade surplus with the U.S. I mean, how could Canada buy more U.S. products than the U.S. buys from Canada? I mean, they're 175% larger economy. So the U.S. is going to have a trade deficit for pretty much every country in the world. So it seems to me there's no way the U.S. is ever going to balance their trade. They can reduce it, so I'm assuming that that's what this game's all about. They want to reduce their trade deficit. They're never going to be balanced. So now we've got Trump has paused reciprocal tariffs on most countries, but he's on a full-on trade war with China. So that's going to get really interesting. This is just going back and forth. Trump raised the tariffs to China to 145%. China says we're going to fight to the end. So now China has just raised tariffs on U.S. goods up to 125%. So here are the two largest economies in the world fighting a trade war. I think this is going to just keep getting nastier and nastier here.
What do you think Trump's main goal is with these tariffs? The fact that he has paused most except for China. Is he wanting to somehow crush China? And how come he didn't pause tariffs against little old Canada either?
Yeah, it's an interesting question, isn't it? I think the China one is really compelling. I was talking to somebody the other day, and they brought up how back in the day, how Reagan had basically bankrupted the Soviet Union, and he was using similar kind of tactics. And I'm wondering, is Trump maybe looking to do something like that to China? We know that the Chinese economy has been in a real slump ever since COVID. We know the real estate market, is basically crashed. So does Trump see this as a ripe opportunity to keep China from becoming the real powerhouse that it wants to be. It may sound like conspiracy theory, but, it could be part of what this is all about. This could be his geopolitical strategy here. He slapped 145% tariffs on China, goods coming into the U.S. You would think that would be a pretty big dent into the Chinese economy. I mean, the U.S. buys a lot of stuff from China, and 145% tariff, that's going to really kill that trade. So if this is the goal, though, I certainly don't see China just taking it, and we're already seeing that China is starting to work with all these other countries now. So I'm pretty sure they're going to push back pretty hard. We've already seen they've raised U.S. tariffs 125%. So then you got to look at, well, what else could China do? And one of the main things to me I've been talking about for a while is China has over 60% of all the rare earth production in the world. And they process and refine over 90% of all those rare earths. And for those listeners of yours who are not familiar with rare earth minerals, they are critical for advanced technologies like computer chips. But they're also very critical for military technology. So, like missile guidance systems and jet airplanes and jet fighters. So withholding these minerals, that would severely restrict the U.S. further expanding their military superiority. And we also know that China has the second largest foreign holder of U.S. debt behind Japan. I know we've discussed this on your show before, but over the last year and a half, China has been selling U.S. bonds and buying gold. So we really need to keep an eye on this. If Trump is trying to do to China what Reagan did to the Soviet Union, how is China going to respond?
Any chance their response could be like Argentina, which faced rampant inflation and other financial problems in the 80s, invaded the Falklands, creating a war to take their citizens' minds off their bad financial times? Exactly. Would China invade Taiwan?
Exactly. That's exactly what I'm sort of getting to. Is you got to watch out what you wish for, right? Like, China is not going to just sit there and take it and be beaten over the head with a bat here. They are going to do something. And just as you said, that card that's on the table, and that would be an escalation that we certainly don't need. So like I say, it's going to be, it could get really nasty, and something like an invasion of Taiwan, that could be brutal.
Many of the things the U.S. has applied tariffs to are not currently produced in the U.S. Things like avocados, coffee, also cheap manufacturing. Will farmers switch their plans in the U.S. to grow avocados, or will Nike or Lululemon build plants in the U.S. to produce their product and avoid tariffs? Yeah. This whole concept that everybody's just going to move to the U.S., the real issue here is the Trump administration, they had been selling this whole concept that these tariffs were going to be put into place and that they're going to remain in place forever. But, we've already seen this history of flip-flopping. Tariffs are on, tariffs are off. We had Liberty Day or whatever it was called, and then, here we are, 7 days later, the tariffs are off again for most of the countries. And if you're a company, are you going to spend billions of dollars over the next couple of years to build new plants in the U.S. if you're not even sure if these tariffs are going to remain in place? And that's the real problem for the stock market right now. Let's take your avocado example. So if you're a farmer and you're currently growing other crops, are you going to consider switching to avocado farming? I'm no farmer, but I would imagine it would take many seasons to make a transition from whatever crop you're growing today to grow mature avocado trees that produce fruit that you can now sell. And I'm also sure there's a lot of regulations and certifications that
they would have to go through in order just to sell avocados commercially. So that would be a huge gamble for a farmer. And either way, for the next couple of years, if the tariffs went in place, avocados would instantly rise in price, and they would stay high until American farmers were growing cheaper avocados, if that's even possible. And then, just as you say, so then you get companies like Nike or Lululemon. So, are they going to spend billions of dollars building new facilities and create new low-wage jobs? As investors, are you going to invest in companies that may spend billions of dollars relocating to the U.S., knowing the tariffs could drop in a month, a year, or even 4 years? And, for me, the only way that companies would be willing to spend to relocate to the U.S. would be that they know for sure that these tariffs are in place and so that the rules aren't going to change. And what would give them that certainty? How many times have these tariffs been switched already? So they need clarification. Making a multi-billion-dollar commitment, that's going to require some real clarity here. Warren Buffett calls tariffs an act of war. And I think what we're seeing is this first, shock and awe of this new war. And here's something that's really out of sync to me. The U.S. unemployment rate is at very low historic levels here. So the question is, if all of these companies decide to build in the U.S., who's going to fill all these new jobs? If Nike and Lululemon and other clothing and sporting good producers build plants in the U.S., who's going to want to take these low-paying jobs? And can you imagine the price of a Nike shoe made in the U.S.? I mean, I don't know what the worker in Vietnam makes, but it's not minimum wage in the U.S. The other piece to me is that many of these jobs in the tech sector are highly skilled jobs, and that is why companies are producing them in countries like Taiwan, China, and India. An entry-level software engineer in India will work for $5,000 to $10,000 a year. A comparable engineer in the U.S. at entry level is $80,000 to $110,000, and that discrepancy runs all through the next levels as well. So the reality is a comparable skilled U.S. software engineer is going to be 5 to 10 times more expensive than one in India. So the bottom line to me is it doesn't make a lot of sense to do these blanketed tariffs, trying to get every industry to move to the U.S. They don't have enough workers to fill all the jobs. The price of those cheaper goods made in those countries is just going to go up dramatically, and that's assuming companies would even move to the U.S. International trade is good for everybody if done right. Obviously, things need to balance out a bit more, but hopefully we get some resolution here that occurs over the next couple of weeks, hopefully within that 90-day period, so we can get this global economy calming down and, so we can avoid a global recession and get the stock markets kind of calm down and get life kind of back to some sense of normal.
Yeah, I mean, India, just Googled this, they graduate over 10 million students a year from their universities, roughly 1.5 million engineering graduates alone. But out of that crowd, only 12,000 a year land their dream jobs. So exactly. That's a lot of desperate people willing to work for not a lot of money.
Oh, absolutely. You can right now. You can go online. There's all kinds of these services online. You can post a job you wanted done. Maybe you want a program built. Maybe you want, and you will be blown away how little you have to pay for that. And they work in India. They do the thing. I've done it. It's mind-boggling how cheap it is. So on a big scale, it just doesn't make a lot of sense. I mean, it really doesn't. So yeah, we'll see. We'll see how this all plays out.
With all the noise around the tariffs, how do you see the stock markets reacting?
Well, like we talked about, we got that whole whipsaw action going. got all that uncertainty. Again, we've got China raising tariffs, U.S. raising tariffs, and then we got this big concern about a recession. And stocks do not do well in a recession. One of the things to me is that we've got this Pavlovian sort of buy the dip mentality, and we've seen that play out a few times already this week. We keep being told everything's already priced in, but this tariff war is different. Whenever we get an announcement, which is very often with Trump, there's that initial reaction where the markets, they kind of price in the immediate expectation. And that's what we saw, on Wednesday. After the selling, the story that the tariffs were here for good until the countries removed them, then Trump paused all those reciprocal tariffs for 90 days. And then we got the announcement effect of that, and the markets exploded higher. And then on Thursday, so yesterday, we got kind of the real effect where people kind of go, well, 90-day pause, that actually brings more uncertainty to it. It doesn't solve anything. And so then we saw that reaction where the market sold off. And now today we've got the markets rallying again. So, ever since the financial crisis of 2008, the markets have been addicted to that belief that if something bad happens, the Fed and the government will come to the rescue and pump trillions of dollars of liquidity into the economy. But like I say, this tariff war is different. As we talk, tariffs or taxes, they add to the price. That's inflationary. Rising inflation while the economy slows, that's stagflation. So for the stock market, I don't think the markets are really structured to react to what's happening right now. Like I said, Liberation Day, that was only 9 days ago. It seems like months ago. And, we just talked earlier, like the volatility is off the charts here. This is not normal. The markets are stressed here. The markets, that volatility has been over 40% the last few days now. So, and investors are exhausted. Like it's just up and down, back and forth. People buy the dip, then people sell the rip. And so I just think people need to be very careful here. We told subscribers that, short-term trading in these kind of markets, you can do very well. Day and swing trading, but you have to know what you're doing to do that. It's getting interesting to see how the economy goes for the next little while. We've seen a lot of front-loading of these tariffs. So I think, we've got this 90-day pause. We're probably going to see more front-loading. And that means that, we're going to start to see all this data coming out. And we're probably going to start seeing, oh, geez, the economy looks pretty good. But that's because people like from, copper to auto sales, they were all buying before the tariffs kicked in. And now the tariffs have been delayed. So that kind of rush is kind of calmed down a bit. But as we get closer to those 90 days, if there's no agreements, you'll probably see more of that front loading. And then you're going to see data later on, maybe June, July, August. All of a sudden you're going to see, whoa, things look pretty ugly because consumers are starting to back off again. So right now, all the indicators are flashing a bottom is near. You got relative strength, you got the put call. We talked about the VIX index, you got margin calls, you got doom and gloom, you got blood in the streets here. So if this is a normal market, we should see a nice rally. So we got one, we got a big one, a huge one on Wednesday. Then we sold off Thursday. We got a nice rally today. So the real challenge right now is that the historical indicators I don't think they're going to really be as reliable as they've been in the past because this is new territory. This is not 2021 where, the COVID happened. They shut down everything, shut the supply chain. Governments just started pumping trillions and trillions of dollars into the economy. The U.S. government was handing out $5 trillion worth of checks to everybody with a heartbeat. The Fed added $5 trillion of liquidity into the markets. 2021 was a generational buy the dip moment. It was like a sharp V recovery. I'd be surprised if we get that. I think we're going to see just a lot of volatility, a lot up and down. In 2021, we were coming off the lows with lots of liquidity, boosting the markets. Today, we're coming down from the highs. It's a totally different situation. Now we got the Doji, guys, got Musk with his chainsaw revving up, cutting jobs all over the place. The Fed says they don't really know what's going to happen. You've got, they say maybe they'll cut once, maybe they'll cut twice, maybe they won't cut. So they don't know. It's uncertain. So again, this is totally different than in 2021. You got Trump even admitting there's going to be pain. So earlier in the week, we saw investors trying to buy the dip on Wednesday. Then they got hit on Thursday. They're buying it again today. We'll see what Monday goes. We'll see what kind of noise comes out over the weekend. But once we broke out of that uptrend channel in February, we told our subscribers things have changed here. A correction was inevitable. And then, of course, we've got this trade war happening. So stock market down. The trend is still down. It's not going to be straight down. There's going to be rallies like we've already seen this week. If you're a short-term trader, there's going to be some great opportunities to make, 10. I mean, we saw Tesla up on Wednesday, 22% in a day. But again, half of that got sold off the next day. So you got to be careful. So until we see real clarity in these tariffs, it's going to be very challenging for companies to make plans. And if companies pull back expansion plans, that's not going to be good for their stocks. If we get a big correction, there's going to be a bottom. We all know Warren Buffett, be fearful when others are greedy when others are fearful. Well, right now, I think you need to be careful being greedy. I think there's just a lot of investors who are long, looking for a rally to get out. So short-term swing trades, you can make sense. That makes sense. But I wouldn't be going all in just yet. You need the market to confirm the bottom's in. So for the numbers what we talked about earlier there, 4,800 is the low, 55 is the high. If 55 is broken, then 5,700 would be the high there. If the 4,800 low gets taken out, then you got 4,600 as the new support there.
Your technical trader service has recently implemented some hedging strategies. How vital are those in helping investors navigate the current market volatility?
Well, they're critical. I mean, think about risk management. So it's like buying insurance. You buy house insurance, you buy car insurance. It's hedging protects your portfolio from sudden market downturns. Well, hello. I think we've had a few of those in the last week. Think about preserving capital. Helps investors maintain capital during turbulent times. Stabilization. So you're looking at smoothing out portfolio performance with these sharp market swings. And flexibility, it allows the investor to stay invested while managing downside risk. I believe that, many people, I'm sure a lot of your audience, they think that hedging requires that I've got to use put options or future contracts or short selling. And most investors, they just don't want to do that. We actually tried getting investors, our subscribers, to use those kind of tools way back in the day, and they just didn't want to. They let us know pretty clear. They didn't want to do that. And luckily today you don't have to. So today there are so many now easy-to-use exchange-traded funds that allow you to go long or short any sector, any stock, pretty much any stock. So these ETFs, they trade just like a stock. So if you got your own account, you just go online. They all have symbols. You just click. It's just a click of the mouse. Just in the last week or so, couple of weeks, we've had here's some just from 4 different tools that our technical trader used. So we had a leveraged volatility ETN, 102% gain in 9 weeks. Leveraged short financials ETN, that netted 37% gain in 3 months. We had a leveraged bear ETF, 27% gain. Short the Japanese index, 22% gain. So Jim, if any of your listeners want to learn a little bit more about how easy it is to hedge, about 7 months ago, I posted a really short video. I think it's about 8 minutes long, and it just goes over how easy it is to do. It gives you some. I think there's probably about half a dozen tools in there that you can use, and you can just go into those trades and out of those trades anytime you want. So if they want to do that, just go to our website, thetrendletter.com, click on the videos button in the middle of the home page, and take a look at it. Like I say, it's only about 8 minutes long.
U.S. bond yields have been rising even as the stock market sees a sharp decline. What's driving that?
Yeah, well, there's a big difference here with the Trump, 2.0 versus his first term. I'm sure you remember, like in the first cycle, he was constantly talking about the stock market, and he was using that as proof that the economy was doing so well. But this time, he has hardly ever mentioned the stock market at all. And his secretary, Treasury Secretary, Scott Bessent, or Bessent, I guess, he's a former hedge fund manager. Like, this guy knows the stock market. But when he speaks, he makes it very clear that he's focused on the 10-year yield and he wants it lower because he wants to get borrowing costs lower. He knows that during COVID, a lot of those companies borrowed money, because they had to borrow. Interest rates were really low back then, and they borrowed a ton of money. But those were like, 5-year bonds. Well, guess what? We're 5 years into that now. These companies are going to have to come back and, reissue these bonds. Well, if they're having to pay, right now, the 10-year bond is like 4.5%. That's a hell of a lot higher borrowing costs than they had back then. So he's trying to get borrowing costs down. The talk I always hear from him is tax cuts, deregulation, spending cuts. He hardly ever talks about the stock market, and when he does, he said he's not worried about the stock market. He says most Americans don't own stocks. It's only the very few, the wealthy, that own. So he's basically saying he's not worried about Wall Street. He's more worried about the bond market. He talks a lot about bringing down inflation, which in this tariff war, I'm not sure how he's going to be able to do that. But all of this is designed to stabilize long-term bond yields rather than short-term stock market gains. But right now, just as you said, the bond market has been selling off and yields have been rising. We saw the yields drop down to about 3.7% on April 4th. But today, here we are, like a week later, they're 4.5%. That's 0.8% in a week. That's a big spike in bond yields. This is not what Trump and Bessent want. Rising yields suggest the bond markets have experienced higher inflation in the slowing economy. We talked a bit earlier. That's stagflation. Stagflation makes it really tough for the Fed to cut rates because that would just add to the inflation problem. So we got rising yields. That we know that makes borrowing costs higher, and that's for people, for the home buyers, people with loans, companies, and government. So then the question is, well, why are bonds falling and yields rising when the stock market was going down? Why are bonds not acting as a safe haven? Well, one answer would be that we know that U.S. has to issue between $7 and $8 trillion of new debt this year to cover new spending and maturing debt from previous spending. Remember, the U.S. is running deficits of over $2 trillion every year, and they've got a total debt of about $37 trillion. And the other thing that to me is really important here, we also know that the U.S. and China is in a full-on trade war. We also know that China is the second largest foreign holder of U.S. bonds. Now, we also know that Trump just blinked when the stock market sold off big time this week. And he paused those reciprocal tariffs for all countries except China. Now, we talked about how China can fight back with, rare earths, etc. But also, China, like I say, they're the second largest foreign holder of U.S. bonds. What if China were to say or to threaten, we're going to sell U.S. bonds at the same time the U.S. has to issue trillions of new bonds, to cover their new and existing rollover debt. That would drive the price of bonds down and yields higher. Now, certainly that wouldn't do China a lot of good, but if they wanted to inflict pain on the American public and the stock market, that would be a very good way to do it. Now, also, we've got many foreign countries are pretty pissed at Trump. Why would they want to buy U.S. bonds and support the U.S. economy at the same time that the U.S. is threatening even their closest allies? So I think this is really fascinating stuff. I mean, if the yields keep rising, and, like I say, they jumped a lot in the last week. They're up. They spiked again today, and we're getting closer to 5% or even higher. That's going to cause real problems in the U.S. economy, and that's going to really likely push stocks lower. So, as I say, Jim, it's always it's all connected here.
Now, do you think we've done enough on the dollar, gold, oil, or should we talk into the future here?
Well, I mean, like I say, gold to me is sort of the big one. I mean, it's the most common sense one. People are scared. They're looking for a place to put their capital. If they sold stocks, they want to put it somewhere where they think that at least it's going to be safe. Loading it all into some other stocks or the Bitcoin. Bitcoin's actually done reasonably well holding its own, but it's done nothing like gold. So gold, as I say, if you look at commitment of trader, the year over year, the year over year open interest is low. So even though it's technically overbought here, I think that it's it should pull back, but it's a place I think that people want to get into. U.S. dollar, again, the currencies. If we've got this trade war ramping up, and you got a country like Canada, you got a country like France or Germany, whatever, why would they, as a central bank, support the U.S. Treasury if these trade tariffs are going to be held over their head? And, we went through the whole calculation. These are not based on tariffs these countries are charging the U.S. It's totally based on trade deficit. So it's not even reasonable. And so why wouldn't these countries kind of band together and say, look, why don't we all just dump U.S. bonds or just not buy their new ones and let them have to buy their own bonds? And that means the Fed would have to, blow up their balance sheet again. And you'd be going back to that whole cycle of the Fed owns all the U.S. bonds again. So I think this is what's starting to happen here. I think we're starting to see, as I said, I don't think that the stock market is really prepared for all this. I don't think the bond markets are. This is new. And if Trump wants to keep pushing for this, I think the rest of the world is going to go, okay, how can we fight back? And one of the ways you can do it is you start dumping U.S. assets. And you dump U.S. assets, you're going to dump the U.S. dollar. Now, Trump wants a lower dollar, but, if people just start saying, you know what, we're not going to buy U.S. goods, and we're going to find other trading partners. And, I mean, that can't happen overnight. But if that's, if you've been hit over the head with a 2x4 here by this guy, and you're worried he's going to keep doing it, you're going to look at a good helmet on, and you're going to go look to play with somebody else.
Back in February, we talked about a new service you had about decentralized finance, shortened to DeFi. Can you tell that about us a bit about that?
DeFi, yeah. Well, again, that's now right now it's probably not a real place you want to dump a whole lot of money, but basically DeFi finance, it's similar. In a way to how Bitcoin sort of set up, the whole blockchain kind of thing. But really, again, this is a real game changer. And what we're talking about here is a different way of doing financial transactions. From everything from, loans and selling real estate even, to gambling, online gambling, where you're taking out the middleman, the intermediaries. So, where banks, where you don't need a bank in the middle, where you can do a mortgage directly with some other people, where you can sell, portions of a commercial building and to, millions of different people where everybody across the globe could bid on a piece of that building or that artwork or that asset. So what it does, it opens up that, sellers of these things. Right now, if you've got a commercial building and you want to sell it, well, there's only so many people that would, if it was worth about $20 million, there's only so many people or groups or companies that can afford to fork out $20 million. But if you can open it up where anybody could buy, $5,000 worth of it or $10,000 or $100,000 worth, that just opens up so many more consumers. So our services at DeFi Digest, the first issue went out a couple of weeks ago. I think it was about a week after we were on your show last time. Excuse me. So your listeners can, just send us a note at info@thetrendletter.com if you're interested in getting on that list. It's free right now. We're not going to put it behind a paywall for a while yet. And we want people's feedback. We've been getting some great feedback now. And it's a great way for people to start to understand what this is all about without even having to buy any of these things. But you start to kind of get your feet wet, learning the technology, learning the terminology. I think anybody that's got an interest in learning what the next big thing might be, I think you want to do it. And again, it's free right now. So,
can you tell us about your various services and how listeners can subscribe or get more information?
I could. So we've got 5 services now. We've got the Trend Letter. So Trend Letter started, this is our 24th year. Hard to believe. Started in 2002. It's a weekly publication. And it's generally for long-term investors, although we're having to be a lot more nimble these days, as every investor needs to be. But it's for people that want to understand what's driving these markets. Each issue is about, 50, 60 pages, but it's mostly charts and with just simple, quick bullets explaining, just highlighting what to look for on the chart. So it's a 10-minute, 15-minute read, even though it's just a lot of looking at charts because that's what we do. We're all technical. It's all about charts to us. And what we try and do is teach people how to read charts so they can start to get an understanding of what's a good support level, what would be a real resistance level, what's a good entry level for a stock or a sector. So again, it covers equities, currencies, precious metals, commodities, and bonds. The second one is Trend Technical Trader. So that's an online service updated every Monday, Wednesday, Friday, or these days it's being updated a lot more than that. It's for both active and longer-term investors. It started out as a hedging service, and we just went over some of the hedging, some of the great gains that service has made just because of volatility in the market. But it also covers long positions. It's been doing long positions for the last 7-8 years now. So again, it covers equities, precious metals, commodities, and it includes our proprietary gold technical indicator. The third service is called Trend Disruptors. Now, this is for speculators, for risk capital available. This is a service that invests in disruptive ideas. So we're talking, artificial intelligence, virtual augmented reality, 5G, cloud, Internet of Things, etc. And, with the markets selling off and so much volatility, I think we're going to see some really good buys in this area, not maybe today, but certainly over the next few months. So keep your eyes open for that. And like I say, the one we just talked about, our new DeFi Digest. So again, that reviews developments in the decentralized finance sector. Like I say, first issue went out. You'll see an issue about every once a month right now. And it's gonna help teach you about that whole sector. And then our fifth service is our free headline service. And this is where every weekday morning, we scour the financial news, and we look at what we think every investor needs to be aware of. And some of these items are things that you won't even see in the mainstream media. But it's stuff that we think that you should be aware of. So what we do, we send those out every morning, 5 days a week, and then the readers can simply read the headline if they want, and if they want to read the story and the article, they just click on it, and we take them to the source of that information. So that's free. If any of your listeners have any questions about any of our services or what's happening in the markets, they can just, and if they want to sign up to headlines, just email us at info@thetrendletter.com.
Martin, thank you so much for being on This Week in Money.
Oh, always a pleasure, Jim. Enjoy the weekend.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. He was speaking to us from Coquitlam, BC, which is just a short drive down the freeway from Vancouver. Our conversation took place on Friday, April 11th. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Yeah, thanks for having me back, Jim.
Can you tell us a bit about Inside Track, spelt with 2 I's, and how our listeners can subscribe?
Yes, Inside Track is a financial markets advisory service really focused on technical and cyclical analysis. And the best place to find out more information and or subscribe is at our primary website, InsideTrackTrading.com. And as you mentioned, that's spelled with the extra I in the middle, so it's INSIIDE, TrackTrading.com.
And I always ask for new listeners, why the double I?
It all has to do with an acronym when the newsletter was first created 30 years ago, and each of the letters standing for the primary market complexes that were being covered.
You had a great call on April 3rd, 4th, and 7th for a multi-week bottom in the stock markets. Is this based on the 17-year cycle? And what is the 17-year cycle?
Well, yes, actually there were a lot of factors that have been prompting me since late November to explain why I thought that the markets would see a sharp sell-off in the first quarter, that sell-off would amount to a 20 to 25% drop in most of the primary indexes, and that it would bottom in late March, early April. As we got a little bit closer, it started to focus on April 3rd to the 7th as the most likely time for a bottom. So that was a combination of a lot of factors, but the overriding one is definitely the 17-year cycle that I've discussed almost ad nauseum in our previous discussions and in a lot of my publications. But it's a cycle that I think is a key cycle in our world and is something not to be overlooked or underestimated. It is very closely linked to geomagnetic swings in the Earth. It is, now that they've discovered, it's probably the secondary sunspot cycle, second only to the approximate 11.2-year sunspot cycle. And it is one of the primary cycles that influences and times the geomagnetic or electromagnetic to and away swings between the magnetivity of the sun and the earth. So it has a lot to do with magnetic forces, which have a lot to do with emotional swings, which have a lot to do with mass psychology. And so it is a very consistent and very telling cycle.
The Dow put in a double top in early December and late January around the 45,000 mark. Is the Dow likely to see 45,000 again anytime soon?
Well, with that final clarification anytime soon, I don't really think so. But I'm speaking of over the next month or so. I think there's a lot that needs to happen, first of all, to confirm that the early April low is more than just a 1 to 2 week bottom, although I do expect it to be more than that. But the ensuing action is going to have a large influence on determining what I expect in the coming weeks and months. So just pinpointing that particular high in the Dow, I'm not sure at this point, but I don't have a high confidence level that it will be reached anytime soon.
The crash of 2020 had larger percentage drops in the stock markets than we've seen so far. Are there further downside targets for the stock markets?
There are definitely additional downside targets. And going back to that 17-year cycle discussion, that's the one that has timed on an uncanny regularity basis. Anywhere from 20-25% up to 45 to 50% drops in the stock market. And all you have to do is look back at 2007, 2008, and which was 17 years ago, to see one example. You can also look back at the 1973-74 drop of 50% that is right in line with this same 17-year cycle. I'm not saying that this particular one is that extreme, but there are definitely some additional downside cycles, and that is, as I said before, one of the primary reasons that my work was saying to look for a major top in the fourth quarter of last year. And as that came closer to fruition, it became clear that very late November, in some of the leading weaker indexes like the S&P Midcap, Russell 2000, Dow Transportation Average, and ultimately the Dow Industrial Average, would set their 6 to 12 month peaks, and why we would see a few sharp sell-offs in 2025, with the first one accelerating lower into late March, early April. So I definitely look at this as the first phase of that overall process, but I think there's more on the horizon.
Does the VIX have a cycle, and what does the VIX stand for?
The volatility index, I don't really follow that from a cycle perspective. It obviously tends to swing up and down when you have the big moves in the market, but it's not something that I watch that closely, so I couldn't really comment on specific cycles in the VIX.
Could trade wars and tariffs have an effect on the 17-year cycle, or is it the other way around?
That's what as you started to say that, I was going to say it's probably more of the opposite, that something like this 17-year cycle, and a lot of cycles and technicals, they are very sensitive to things going on in the market that aren't yet obvious on the surface. They pick up when the powers that be or those in the know are starting to make their moves in the market, and you can believe there were people making moves in the market that knew what was coming. And so it's more the other way around, that the 17-year cycle has an impact on things like that, and on a lot of what are sometimes called black swan events. Even though the 17-year cycle might not tell you the specific fundamental that is going to cause a market sell-off, for me, that's not that important. I'm just want to prepare for it and then wait and see what that fundamental driver might be.
Gold pulled back with the stock markets. What do you see ahead for gold?
Gold actually almost matched the magnitude of its two largest declines over the last couple of years with the recent pullback. So there's some symmetry between its corrective waves, and it could easily see a rally to new highs now that it has nearly matched that corrective magnitude. But really, the more important thing for me was seeing silver finally drop down and reach that 2750 downside objective that I've been writing about since December.
Silver also pulled back with the stock markets. What do you see ahead for silver?
Well, along with that downside price target, there was also an entire wave structure, and there was, a very decisive weekly trend indicator I used. And all of them were telling me as silver was rallying back towards its highs in March, they were telling me that we needed another wave down, a larger magnitude C wave of an ABC correction. If you look at the initial late October through December decline as the A wave, and now the very struggling rally since then as the B wave, and then a C wave decline to follow. So the wave structure was saying that, but even more importantly was this critical weekly trend indicator that I use and write about in all of my publications. And that was telling me that silver had not been able to turn the broader trend back up. It was more in a trading range neutral type of status on a 3 to 6 month basis. And it was showing that it needed to drop below the mid-December low before it could rally and set new highs, which I do think are still on the horizon. So that was really the more telling aspect or result of the recent sell-off. And I think that primes silver to start to go through a bottoming phase and potentially see a new bull market that I think could last easily 6 to 12 months. In fact, throughout this year, since the beginning of the year, I've explained why I thought if silver did see that second correction, and if it bottomed in April, that would reinforce some very decisive cycles out in 2026. So there's a lot going on right now in silver. It certainly needs to confirm a bottom and give some new buy signals, but there were a lot of key objectives met with this recent sell-off that I think are starting to get rid of any overbought nature in silver from a 6 to 12 month basis and start to prime it for a new advance.
The U.S. dollar's been pulling back since the beginning of the year. Where's the U.S. dollar likely headed from here?
Well, that's in lockstep with what you and I have talked about and what I've been discussing with my readers. One of those has to do with the political connection to the U.S. dollar that I recall talking with you about back in 2016, again in 2020, and then in 2024. And that is that over the last 40 years, the dollar has tended to move higher during Democratic administrations and lower during Republican administrations. And there's reasons for that. That's, not necessarily a good or a bad thing one way or the other. That just is the direction it's moved. And that's also in sync with some of their economic philosophies and objectives. And all of my work last year was telling me that 2025 would be a down year for the dollar. So if that political connection held true, we would likely have a Republican administration in office. And I think that the dollar is, on balance, going to work lower into the latter part of this year. And at that point, we'll see if it is set up for another multi-year bottom, or it's just a pause of a larger decline. But I do think that the dollar is going to work. And as I said, I emphasize the on balance phase there, because a lot of times people think that if you're looking for a low to wait until the end of the year, that means that whatever market you're talking about should just go straight down to the end of the year. That's not the case. That's almost never the case in markets. And just like I was talking about with silver, you had critical cycle lows in December and then again in late March, early April. Once it started to rally from December and started to show that it still needed to make lower lows, ideally in April, that doesn't mean and didn't mean that silver's to trend down for that entire time. And as we've seen in that case, once again, silver fulfilled those cycle lows and did it with just a few-day sell-off. So as far as the dollar's concerned, you could certainly see an important bottom take hold in the near future. You could see a lengthy phase of consolidation, and whether that just ends up being a few week or a couple months sell-off into cycle lows at the end of the year, or if there is a longer downtrend, that remains to be seen. But on balance, I think the dollar will work lower into late 2025.
The Canadian dollar is showing some strength after a nasty low at the beginning of February. Is the Canadian dollar looking bullish?
The Canadian dollar is certainly looking bottoming, and even for it to be holding up these last few weeks with the price of crude dropping so hard, and often having that kind of petrocurrency relationship or correlation, the fact that the Canadian dollar has not suffered as much during the recent energy sell-off, I think is a reinforcement that a bottom is taking hold. And I've described in my monthly newsletter, Inside Track, for the last few months, that the Canadian dollar was expected to hold that multi-year support near 68 to 69. That's where lows were set back in 2016 and again in 2020. But there still are some technical signals I need to see before I would be convinced that a 3 to 6 month or 6 to 12 month bottom is intact.
The price of crude plunged along with the stock markets and the U.S. dollar. Is the crude oil cycle continuing to be in sync with the stock markets and the greenback?
You know, it for the most part, it does move along with equity markets. I will sometimes talk about the energy equity connection, but it's more when you have the more extreme moves in either. It's not a day-to-day and week-to-week correlation. And obviously there's always other factors that might be influencing one and not the other that can disrupt that correlation at different times. I don't see the correlation as closely with the dollar, particularly when crude is the one leading, which seems to have been the last week or two. And so the overall cycle in crude and the trend in crude remains down. Coming into this year, I talked about how I thought that it should peak in April and then see another sell-off follow that. I have to admit it peaked a little earlier in April and at lower levels than I expected, but that just reinforces the overall weakness that persists in the energy markets.
Bitcoin put in a double top mid-December and mid-January. Is this a bearish sign for Bitcoin?
I think on the whole it is. But I think that we have completed the first leg down, and I'm more looking for a bounce here in the intermediate term over the coming couple of weeks at least. I've got a couple of upside targets that I think could be reached in that time frame. But on a little bit broader basis, yes, I think that double top is more of a bearish factor. But I would need to see Bitcoin give a weekly close below 76,000 before I would turn additionally bearish on it. It has certainly seen a good sell-off and dropped right to some key support levels. Since December, I was talking about seeing a pair of sell-offs first into early February, then into early March, and you should see some multi-week lows set at those times. Bitcoin did just spike barely to new lows with the stock sell-off, but its close was well above the previous lows, so that too shows that it is probably putting in an intermediate bottom, and that we could see that bounce into some key intermediate cycles that come together a little later in April.
Does it look like lithium has a cycle, and could it be affected by trade wars and tariffs?
I definitely think it could be affected by those, but I think that the real problem lithium has had for a while is oversupply, and it's hard to really distinguish any convincing cycles on an intermediate basis. It remains in a prolonged downtrend, and so there's not any strong indication there of a bottom. In fact, at the very least, I would have to see it give a weekly close back above 10.50 before I would even start to pay much attention to it from a bullish case.
The violence cycle accurately predicted the Russian invasion of Ukraine. What is the violence cycle in right now, and what is it telling you?
The violence cycle. I certainly have discussed the 80-year cycle of war that was predicted to come back into play from late 2021 through late 2025. Russia absolutely validated that cycle, and other things that have gone on in that time period have reinforced it. And many cycles kind of adhere to that 90-10 rule of cycles, where you see a blow off into the end of the cycle. So I'm still very cautious where the end of that cycle towards the latter part of this year is concerned, and whether there is any more additional or different conflicts on the horizon.
Eric, where can people subscribe to Inside Track with two eyes?
They can subscribe through our website at InsideTrackTrading.com. That's inside with the two I's, INSIIDE, TrackTrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from Central California. Coming up, Hilliard MacBeth, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBeth.McLeodPartners.com. Find him on X at HMacBE. Welcome back to This Week in Money.
It's great to be back.
The second edition of your book, When the Bubble Bursts, is on sale now. Would reading your book be a good idea right now?
Of course, it's a great idea. Actually, it's funny, because it's 9 years since the first edition came out, and about 6 years since the second edition came out. And the stuff is now turning out to be quite on the moment, like timely. I was obviously early with my prediction about a housing bubble bursting, but now we are in the middle of it. And of course, one thing to remember is that the bubble will take several years to unwind. So it's not a single point event in time. It's an era of the bubble bursting. So there's lots of time to read it, lots of time to get it, and the second edition has the red cover, so I encourage people to get the second edition.
Mm-hmm. Yeah, and it's not that long a book either, so if people think they're going to be wading through a War and Peace, it's quite a reasonable piece to read. You could do it in 2 or 3 sittings easily.
Yeah, I think if somebody sat down, and I talked to a couple of people, it's about 3 hours in one sitting, or 2 shorter sittings. It's quite doable. And one of the things in there that I did a lot of research on was the banking system, and how the banking system is so crucial to the housing market. And it never gets mentioned. People talk about the Bank of Canada, they talk about the politicians, they talk about foreign speculators coming in, they talk about money laundering, but they never talk about the role of the banks. And that's, that'll come out more as we go through this probably financial crisis that is looming. And people will see that the banks actually are crucial to how the whole thing works.
What I found most interesting is how money is created in Canada. There isn't a big pile of money that the banks go and dip into and hand out in mortgages. What really happens, Hilliard, when you get a mortgage? What does that do to the money supply?
If most of us have done a mortgage or two in our lives, and we might remember that moment when we signed the papers and sitting in the banker's office, and the next thing you know, within an hour or a few minutes, that large amount of money appears in our bank account. So it's created out of thin air. And that's why when the banks are lending for mortgages, they're expanding the amount of money in the system. And when they stop lending money for mortgages for house purchases, that's why the politicians, the Bank of Canada, and everybody gets so spooked, because the money supply is actually shrinking as they're not adding to those, because everybody's making a mortgage payment every month, or at least almost everybody. So you have to keep adding more fuel to the fire, or the fire will go out. And that's the point we're at right now, is they need to keep creating money, but they're not able to create money if people aren't taking out mortgages. And lately, things have really slowed down.
So really, at the press of a button, they're creating hundreds of thousands of dollars in a flash.
Yes. And, the idea that, there's a limit or some sort. There's no limit, because you couldn't have, like, the Royal Bank of Canada, just to pick the biggest bank. They've got thousands of people every day handing out mortgages at all their different branches, and they don't keep track. The banks aren't that sophisticated on their computers that they could actually say, well, the guy in Edmonton wrote 3 mortgages and the guy in Vancouver wrote 7. Therefore, we better slow down in Toronto because we don't want to go over our limit. There is no limit. They can keep going. Every couple of weeks, there's a moment of reckoning where they have to make sure they have reserves available to support those mortgages. But there's never any problem with those reserves, because the Bank of Canada will supply those reserves. So it's basically, when things are hot and things are going, it's just like, make hay while the sun shines. But we're not in that mood anymore. Now it's a completely different mood going on right now.
What's the latest on Canadian home sales?
Well, there just aren't any. That's the shortest answer. There just aren't any sales. I mean, there's a few, and Edmonton and Calgary are holding up not badly, but Toronto and Vancouver, things have really slowed down. And the problem is, you're at that point in the cycle where the sellers still remember that peak price from 2022, and they don't want to drop a lot below it. And the buyers are more aware of the fact that prices have come down in some parts of the country quite substantially. Like we're talking 20 or even 30%. And they're not willing to reach up to what the seller's imaginary price is. They want today's price. So there's a gap there, a big gap. And it does get resolved eventually, but there's a period of months or even a year or two where everybody's kind of frozen. And that's where we're at right now.
What's happening with asking prices and sale prices of homes?
Well, so what happens is that if it's a really weak market, and it is, I mean, you look at the listings are just, if there's 100 listings, there's only 25 sales. So why would you list your house in that? Why would you add your house to the 100 that are already for sale and only 25 are sold? It's usually because of desperation. So it's either the owner is desperate, or the lender has gotten involved, and the lender is saying, "Hey, we got to get this thing." And the thing with the lender is, the lender doesn't care what the previous price was. The only thing the lender cares about is how much debt there is on that property. They don't care about the 2022 peak price that was hit. So the lenders are much more ruthless in terms of chopping the prices, and that's why you're starting to see some anecdotal evidence of some pretty big price cuts. A home that's sold for $2 million is now selling for $1.4 million, but it's forced by the lender. The actual person that paid $2 million for that home in Toronto just can't bring themselves to drop the price down to 1.4. If they have the financial wherewithal to hang on, they'll just take it off the market and just say, "No, I'm not selling."
Is housing inventory piling up?
For sure it is. Yeah, there's as I say, the listings are way outpacing the sales. And it's a bit of a mystery as to why people keep listing their houses more and more, but I guess the answer is desperation and piling up. The other thing that happens is, when we look at the listings and the sales, we're looking at the CRA primarily, the Canadian Real Estate Association. But there's a whole other sliver to this thing, a whole other silo, and that is the new home builders and the new condo builders. And their sales are done separately, and they've got a tremendous amount of inventory sitting on in their books, and they'll do stuff like they'll have incentives to buy a property or something, but they've got constraints as well. If they're doing phase 2 of a project, they sold all the homes in phase 1 for $500,000. They really don't want to cut the price to $400,000 for phase 2, because then now they got a whole bunch of upset people that bought just a year ago for $500,000. So there's all kinds of little wrinkles like that. And what usually happens is nothing happens until somebody forces the issue, and that's usually the money that was borrowed from, in the case of the builder, from a shadow banker. Usually, the builders generally don't get funded by banks, or in the case of an individual homeowner, is probably could be the bank who forces the issue with foreclosure and that sort of thing. And that we're starting to see that. One of the contacts I made after my book came out was with a group of bankruptcy and insolvency people in Ontario, the largest group, and they're starting to see homeowners come in. They've never seen homeowners come in before. It was always people that didn't own a home, because the homeowners, every year the price of the home would go up and they could refinance their debts. If they got into trouble, they could get out of trouble just with the gain in the price of the house. But now they're starting to come in. So they're starting to see that the equity is shrinking in the home, and they can't keep up that credit card debts. And so they're coming in to talk to the insolvency person. And that's a sign that there's some pretty dire situations out there.
In a real estate downturn, at what point do investors try to get out?
Well, it's always too late. If they sold it, it's the same in the stock market, which is my main activity. People are always on the way up. They're always their greed doesn't allow them to get out. Even if they get out for a while, they get back in again, because if the market keeps going up, they buy back into their favorite stock or Bitcoin or whatever. But when things start to go down, the first reaction is to hang on. I'll wait for it to come back up. And investors in housing are identical to that. They say, well, I'll just hang on. But at some point, usually they have debts, right? I mean, almost every investor has debt unless they're laundering money or something. So it's usually when they're forced because of the lender. So again, it'll get back to what the lenders do. And since COVID in 2020, so now we're 5 years into this, the lenders had the idea that they would do forbearance or we'll work with you to get you through this tough period. Well, now the tough period is, initially you had all that money from COVID money, and now that money's run out, and now we're into the really tough times, the really tough discussions that lenders are having with people because there is no more COVID money, and then they'll have to force, and investors will be forced out of their properties by the lenders. That's usually what happens anyway.
Do mortgage rates look like they'll head lower?
If we get a recession, and almost undoubtedly, we haven't talked about the tariff situation, but almost undoubtedly we will get a recession. The mortgage rates will come down. Already in the U.S., we're talking on Thursday here, the CPI came out it's still above 2%, but one interesting thing, the shelter index, which is the biggest part of the CPI, actually started to slow down. It's still above. It's still at 4%, so it's still like a point or point and a half above the CPI. But it was pulling the CPI higher, and now it's started to moderate, and it'll come down, and then it becomes a self-reinforcing thing because mortgage rates are part of the CPI, and as the CPI comes down, the mortgage rates will come down. But the thing is, it doesn't mean there's going to be a whole bunch of buyers out there because we'll be in a recession, and then people have to qualify for the loan. And that's tough in a recession. So people that have a job are afraid they might lose the job, and so they don't apply for the loan. And the people without a job, they can't get a loan.
Is mortgage lending tightening up?
Well, I think it has. I think there's been some, as I said, there's been some activity at the insolvency, bankruptcy shops, and the banks will start hearing about that. And human nature being what it is, they'll get more cautious. And I mean, the bankers usually their jobs are pretty safe, but the one way they can lose their job is by making bad loans and having a bunch of defaults. And so they get pretty cautious when things start to slow down. And the government's made some changes to the rules as well, and they're talking about more changes to the rules. So. It's what we call pro-cyclical. I wrote about that in the book quite a bit. When the boom is on, the banks loosen up their standards and they make loans they probably shouldn't have, or they definitely shouldn't have. And when we're at the bottom of the cycle, the banks tighten up, which is probably when they should be loosening up, but they tighten up and they make things worse. So those loans would be pretty solid because the prices have come down and the borrowers pretty solid in their employment. The banks will get really, really sticky at that time.
Well, I guess they're just not sure you'll have a job to pay for that mortgage.
I thought about that, because when you think about like a horrendous recession, I don't know how bad this recession is going to be. It's probably going to be pretty bad. We haven't had a really severe recession since the 1990s in Canada. We missed out on the 2008-2009 period. But in a really bad recession, unemployment goes to about 10%. And unemployment in the Canada's right now is about 6%. In the U.S., it's about 4.2%. So that's a doubling or tripling of the 2.5 times the number of unemployed. And yet 90% of the people still have their jobs, right? So it's like, well, so what's the big deal? Why is it so bad? Why is a recession with 10% unemployment like the end of the world? Well, those 90% of the people that still have their jobs, they're afraid they might lose their job, right? So they stop spending even though they haven't lost their job because everybody knows somebody who's lost their job and nothing, causes people to stop borrowing money more quickly than the possibility of losing their job. So the bankers tighten up, but also the borrowers tighten up too. And we won't know until we get further into this down cycle here that we're in how bad it gets. But 10% unemployment is if you're thinking about is the recession about to end, when it hits 10% unemployment, that's usually pretty close to the end of the recession, which is obviously a few months away. We haven't even officially entered a recession yet, but it's something to keep in mind as we go into this.
The stock market's plunged, and according to Eric Hadik, who was on the show earlier, right on time. What do you see ahead for the stock markets?
Well, yeah, I mean, it's like the stock market is down. Yeah, well, it was down last week, cumulatively about 15% year to date. So the worst start to a year in decades, if not forever. I don't know. Yeah, I saw all these charts, and I don't know if there has been a period before where it's gone down that quickly. And interestingly enough, when a new president in the U.S. takes over, it's never been this bad. So the stock market in the U.S. So I got to talk about the U.S. stock market because it's the most important stock. It's depending on which measure you use, it's either 50 or 60 or even 65% of the total value of all the stocks traded in the world. So it's huge. And the problem with the U.S. stock market is that because of a few stocks like NVIDIA and Tesla and some of those high-flying stocks, Microsoft, and the whole narrative about AI, they got very overpriced, and they still are overpriced even after this 15% downturn. So we've got a ways to go yet, and the problem for the rest of us in Canada and Europe and Japan and China is that even though our stocks might not be that overpriced, our stocks will get pushed down as the U.S. stocks come down. So I think we're going to see last week we hit the bear market, which is 20%. That's the sort of the arbitrary indicator. But probably that isn't going to be enough to end this bear market. It's not a big enough drop. And also we haven't seen the recession yet. So if we get a bear market and a recession, then that's usually a sign that we're looking at a 40 or 50% drop in stocks. So we're about maybe 40% of the way there. And how long will it take? Well, it could be over in a couple of weeks like it was in 2020, or it could take a couple of years like it did in 2000, 2002 when the dot-com bubble burst. I'm guessing this is probably more like 2000, 2002. It might take some time to unwind, but we're a few months into it already, so we might have a year to go. And people should keep a close eye on it because there'll be some tremendous bargains, but the bargains aren't here yet.
The U.S. dollar's been in a downturn since the beginning of the year. What are your thoughts on the greenback?
So the thing about the U.S. dollar is we measure it in, like what is the value of a U.S. dollar? Well, it's what can it buy? And so the index they use, the DXY, is a trade-weighted index of all the countries that the U.S. trades with. Canada's got a big weighting. China's got a big weighting, different countries. And but the better way to look at the U.S. dollar is the price of gold. So the price of gold currently is $3,100 per ounce. And it's come up from $1,000 per ounce in the last few years. So if you look at it simply in the terms of gold, the value of the U.S. dollar has dropped by 2/3 already in this downturn in the U.S. dollar, if you like, and it's also been weak in terms of the trade weighted index as well. So there's two things happening with the U.S. dollar. A lot of people invested in the U.S. stock market. It was the hottest stock market in the world for the last 2 or 3 years, and now they're pulling their money out. Like we've never seen the outflows that have happened. And when you pull your money out of the U.S. stock market and you go into the European market or wherever, you have to convert your money out of U.S. or usually you have to convert your money out of the U.S. dollar. So there's a lot of pressure downwards on the U.S. dollar. The other thing that's happening is the U.S. dollar, of course, is the reserve currency for the world, and it's also the number one currency for trading. So when people buy and sell oil, for example, which is the most valuable commodity traded on world markets, they always trade in U.S. dollars. So you have to buy gold in U.S. dollars, oil in U.S. dollars, and so oil has dropped below $60 a barrel. So the amount of U.S. dollars that are required to buy a barrel of oil have dropped from $100, let's say, down to $60, and that'll affect the U.S. dollar as well. So we're in a period of a weak U.S. dollar, but on the other side of the coin, there's another cross current going the other way. Is that in the past anyway? I'm not sure if it's going to hold up this time, but in the past, in the last 50 years that I've been doing this, people always run to the U.S. dollar for safety when there's a crisis, a financial crisis, and this is definitely starting to look like a crisis. So people will start buying the U.S. government T-bills or bonds, short-term bonds, as a safe place to park their money. If they don't go there, and they might go to gold or some other thing. But certainly, it's kind of up in the air right now whether the U.S. dollar will keep its status as a safe haven place of choice. Maybe there'll be a new one to take over. I don't think it'll be Bitcoin, but it might be gold.
Are you bullish on the Canadian dollar?
No, I'm pretty bearish on the Canadian dollar. We went down to, I don't know how low it got. I think it got that down to 67, 68 cents. It's back in this latest few weeks here. It's actually rallied back up to 71 cents against the U.S. dollar because the U.S. dollar has been weak. But with a weak price of crude oil and the problem with the housing and the debt in the private sector in Canada being so much more severe than in the U.S., the Canadian dollar is probably going to be quite weak for a while. And when I say for a while, I mean for months or a year or two. So I'm not particularly bullish on the Canadian dollar. No, it's not a safe haven either.
Gold dropped along with the stock markets. Where do you see gold going from here?
Well, gold dropped temporarily, but it's right back up to $3,100, which is very close to the highest it was. So unlike the stock market, which is still down 11% year to date, something like that, as I mentioned, the peak was 20% decline. Gold has recovered the whole thing. And really what, I don't know if you're going to ask me about gold miners, but I was just looking at gold miners here, and because that's one of our favorites. And they're up on the index. They're up 41% year to date, and gold isn't up quite that much itself. The gold price isn't up that much, but people are starting to move into the gold itself, but also the gold miners. And the other thing that happens with the gold miners is they get an extra boost if they can find some more reserves in the ground, and they can because they've got money now with profits have soared for gold miners, and they can do more exploration. Plus, the formula for calculating their reserves depends on the price of gold. So at $1,000 an ounce, they've got a small amount of reserves, but at $3,000 an ounce, they've got a much larger amount of reserves. They just previously weren't allowed to include those ounces in their reserves because the price was too low. So the bigger leverage would be with the gold miners, and that's why they're up 41%. A little tidbit on the gold miners that probably most people don't know is, the S&P 500 obviously has 500 stocks in it. There's only one company in the S&P 500 that is a gold mining company, and that's Dumont Mining. So the people that buy ETFs in the stock market are way underweight the gold mining sector. Because there's only 1 out of 500 stocks in there. Newmont is up year to date. It's up about 38%. The more Canadian company is called Agnico Eagle. It's up 44% year to date. But I think there's still lots more room for those ones to go higher. Their PE ratios are still a lot below the average of the other stocks on the stock market.
Silver has also dropped along with the stock markets. Where do you see silver going?
So what happens so I just mentioned that Agnico Eagle's up 44%, Newmont's up 38%, and the miners are up 41%. What happens is people start going and looking at silver. Say, well, gold's already moved. You don't want to buy gold. Don't want to have gold miners. And so they start looking at silver. But really, in the past cycles that I've been involved in, going all the way back to the late 70s, the better place is gold. Silver generally tends to go up along with the gold miner, and actually silver's got some interesting little quirks to it. It's used a lot in certain products related to solar panels and that sort of thing. So there's demand for silver in that rate, but gold is if you're looking at financial speculation, gold is the top of the pyramid for sure.
With Canada's election coming up on April 28th, do you think Canada is in for tough times ahead? Well,
the election, whether Carney gets in and sort of, gives us the calming approach, or whether Poilievre gets in and gets us all excited. It won't make much difference. The big thing is the tariff war with the United States, and that's a huge problem for Canada. I don't know if people realize, but depending on how you measure it, these numbers change, but different. But the GDP in Canada is very, very exposed to international trade, and as much as 40% of all our GDP is related to trading with other countries. It's much, much smaller in the U.S., and so the U.S. doesn't really care that much about trade. There's other reasons for what they're doing, I think, related to the president and things like that. But in Canada, we live and die by trade, so we could be in for tough times. There's no doubt.
If Mark Carney, the Liberal leader, wins the election, is Alberta going to separate?
I don't know if you and I talked about this before, but I think we might have. But anyway, I went back because in the 1980s there was an independence separation movement, and I looked back and there was a party. I'm trying to remember the name. Anyway, it doesn't matter what the name is. But that strain of the Alberta politics has been there for a long, long time, probably going back to the 1930s with William Aberhart. And now today, then there was Ernest Manning, and now there's Preston Manning threatening all kinds of stuff, the son of Ernest. And but the two, if I can remember this properly, the two were the two biggest issues for the people that joined the Separatist Party in Alberta in the 1980s was bilingualism, the ramming French down our throats, and converting to the metric system. Those are the two biggest issues. So today the complaints are quite a bit more serious, like the imbalance of how the financial largesse of Alberta is spread to the other parts of the country, and perhaps there's a significant number of Albertans that would like to join the U.S., but there aren't very many that want to join the U.S. in other parts of Canada. But no, I don't think it's threatened quite a bit, but I don't think it would happen. We don't have a reason to separate that's strong enough. If anybody was going to separate from Canada, it would have been Quebec, and because they at least they have the language and the culture and all that. But even they didn't really ever get that close to separating. Although the referendum was pretty close, but I don't think they really wanted to separate.
Did you sell your Tesla?
No, but I wanted to get. I haven't been able to find that bumper sticker that I was going to put on it, which was. I bought my Tesla before Elon Musk went crazy, so it's like, I don't know where they sell that bumper sticker. I should get it, but no, I've been looking at other electric offerings, but there still aren't as many cars as there should be in that segment. The best ones are coming out of China, and some of them look really impressive, although I haven't test driven them anything. But very competitive, like a car. So I've got the Tesla that's the fastest one, the 0 to 100 in 2 seconds. And there's some.
Have you done that?
Oh yeah, it's fun. It only takes like 300 meters or 250 meters, and so then you can do it pretty much anywhere. And I do it for the passengers, and then the passengers, some of them say, "Oh no, they don't like it because it's too fast." But it's kind of ridiculous because the regular Tesla goes 0 to 103 seconds, and that's already still pretty fast, right? So anyway, but these ones out of China, they match that kind of performance, and BYD's got one, and another company called Xiaomi's got one. Even Huawei, everybody's heard of Huawei as a telecommunications company. They've got a car too. And these cars are amazing, and they're almost as fast as the one I've got, and they're like a third the price, right? Or half the price. So I just came out today, and we're talking here on Thursday, that the EU is talking about allowing Chinese cars into the EU, but you can't bring a Chinese car into Canada because the tariff is 100%. So it wouldn't make any sense to bring it in, but.
Or would Canada keep the 100% tariff if this trade war with the U.S. continues? Because that was a lockstep move with the U.S. that put a 100% tariff on Chinese electric cars.
Exactly. That was the only reason they put the 100%, because we don't have, Canada sells 1 million cars a year. It used to be 2 million. It's down to 1 million, and it's dropping it's well below that now with the tariffs and everything. So we don't have a huge car manufacturing industry to protect. But we had to put the 100% tariff because it was actually under Biden, they put 100% tariff on Chinese cars, so we had to keep that relationship. Now, President Trump has broken that relationship, so we would be free to do whatever we want now. But I don't think they'd want to. I don't know if they'd want to do that. Certainly not before the election is over. But the European Union is talking about allowing the which is kind of surprising when you think about all the German car makers there are. But they're talking about allowing the Chinese cars in because they really are cheaper and their quality is up to or exceeding the standards of Detroit now. So it would save people a lot of money. And of course, they're mostly electric cars. If people want electric cars, that's a great place to get them.
And how was your Tesla in cold weather? I mean, Edmonton gets a little frosty in the winter.
You know, the thing with electric cars is they're better in the winter than the regular cars. And the reason is because the instant heat that comes on. So you just go on your app on your phone, you push the button, climate, you put it up to 21 degrees. And within a minute or two, even when it's minus 40 outside, the car is already warm and toasty. By the time you walk to your car, it's warm. And the only issue with the cold weather for the electric car is if you're going on a long road trip, like 300 kilometers or something. The range of my car is 620 kilometers. In the really, really cold weather, it drops down to maybe 300 and 350 kilometers. So you have to get a recharge more often. But other than that, everything else is better in the winter than a regular car.
Hilliard, where can people follow you, and where can they buy your book?
So they can buy my book anywhere, online, the electric version or the Kindle version, that's Kobe version, and that, or they can buy it in bookstores. And as far as following me, I'm still on X. I'm getting pretty upset with some of the political stuff that's on there since Elon Musk has been running it, but still doing it. And but I've also got a presence now on Blue Sky, which was started by the former owner or the founder of X, and it's got a different kind of tone to it. So either one of those, and then if they want, they can also get my weekend note for free, which they can just find me on one of those two, and then it comes out on Friday, and you can just link on there, go to the website and register to get your name on the list to get a copy sent electronically to you, or just message me on Twitter, and I'll add your name to the mailing list. Just need your name and email.
Hilliard, thank you so much for being on This Week in Money.
Nice to be with you again, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. And that wraps up our show for this week. We'd like to thank our guests, Martin Straith, Eric Hadik, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.